Hello, everybody. First of all, I just wanted to kind of echo a little bit of the sentiment that Carlo and both Seth had shared, that NIBA is the type of place where you really just need to get engaged. If you're just here to show up and not engage everybody in the entire process, it's not going to yield you the result that you're really looking for, right? Sometimes it's having a conversation with somebody who introduces you to somebody who introduces you to somebody. You never know where that's going to lead you to. So for those of you who do not know me, yes, I do D&O insurance. I'm known very much in the marketplace for D&O. I've been in capital markets for over 25 years. My company, NSI Insurance, is a leader in the industry, and I run the financial lines practice for NSI. So what is executive risk management? Most people just think it's just D&O. It's not. It's D&O, it's cyber, it's employment practice liability, it's crime, it's fiduciary liability. And most people just look at it as an expense and a cost of doing the business. But really understanding what executive risk management is and transferring your risk onto an insurance policy and away from you personally for your operations of these publicly traded entities or private entity, you do have a fiduciary responsibility to your shareholders to protect your balance sheet, to protect your assets. And if you don't do that properly, or if you have losses in the business, or if you make improper movements, you could be held personally liable. A lot of people don't recognize that. So executive risk is much more than just D&O. I know we're going to focus on D&O today. So why do people buy D&O, and why should people buy D&O? Most of the people in this audience are purchasing D&O, or when they purchase D&O, it's because they have a transaction. They are looking at trying to close capital. You're very much focused on raising capital, and most of the people in this room are running companies that are publicly traded, that are not multi-billion-dollar organizations. You lack resources. You don't have an in-house risk management team, in-house legal counsel. It usually falls into the purview or under the purview of the CFO, and it's an extra job function, cost and expense. So you're really just looking at, what do I need so that I can close my deal, and you're not really thinking about the function of the actual D&O insurance and how it's going to protect you and your personal liabilities. So why should people buy it? And not just to protect themselves, but to protect the balance sheet. So again, two different reasons, kind of the same exact thing, but the catalyst is, let's get a deal done and let's raise some money. The thought process should be, protect my personal assets and protect the business assets. So understanding D&O insurance, believe it or not, I sit in board meetings all the time, and many of the board members and executive team members don't understand the functionality of an actual D&O policy. A D&O policy functions extremely different than any other type of insurance policy that exists. There are 3 primary insuring clauses. Each one of those insuring clauses will respond differently depending on the type of claim that it is. This is a great illustration that totally simplifies the entire process of what a D&O policy is and how it functions and how it works. Had a call today with a group that had a primary ABC policy and no excess side A, only DIC. Of course, the question from the executive team was, what's the difference? Well, the difference is the C side's going to respond to shareholder liability claims. So if a claim comes in for shareholder liability claim, that's the section that's going to respond. That section, that side of the policy, has a retention level of its own. The retention is like a deductible, so it's a holdback. It's what you're going to pay first, and that could be much higher than some of the other sides. In many cases, it could be $1 billion, $1.5 million. Side B is what's going to respond for the entity. So if the entity has inability to indemnify the officers and directors, that's the piece that's going to respond for the entity to actually pay for side A claims when the company does not have the ability to do so. And then the A side is the piece that everybody really cares about, which everybody thinks it is that they have, but in many cases they don't have, like that company I had the conversation with today. So the side A piece, obviously, is protecting the officers and directors very specifically. It never has a retention, so no deductible on that. So first dollar defense, which is what's most important, because most of the time what your cost is going to be individually is going to be for legal fees, right? It's going to be coverage to cover your defense costs. So that's the primary piece that you're actually going to use it for. So what the problem is, or the challenge typically comes in, if you only have an ABC policy, so a primary ABC policy, and you have a shareholder liability claim, and let's say you have a $5 million limit, and the claim comes in, and you have $10 million of losses, there are not enough limits to cover you on the Side A side. So you've completely exhausted all the primary ABC coverage, and there's nothing left to defend you. So you would personally actually have to pay for your own legal fees just for your own defense costs. So structuring one of these policies and programs is imperative to understanding how to properly mitigate your own individual risk. So how do you do that? You purchase the excess Side A only DIC policy. So it's an excess layer that sits on top of the ABC. It sits aside from the primary policy, and it does not share in the limit of the ABC. Just out of curiosity, a lot of people, I saw everybody raise their hands in here. Of the people that are running public companies or private companies, just show of hands, how many people understood the difference of what I just explained? One. Wow. Right? And just think about that from a risk standpoint, right? So when you look at the fact of understanding what your own personal liability and potential risks are for running one of these public companies, this is not part of what my presentation is, but I'm going to go backward for a second and tell you a little bit about my own personal experience. I come from capital markets. I have taken my own companies public. I've done reverse mergers. I've done S1s. I did a VC-backed deal. It did not go exactly the way that I had wanted it to, and I became an expert in D&O insurance overnight, and it cost me almost $1 million of my personal money. Don't be that guy. We ran out of primary ABC limits, and we didn't have enough in the excess layer. So understand your structure, right? So if you don't understand what your structure is, you could be leaving yourself By the way, nothing happened there. It just cost the legal fees. And it gets very expensive. Limits. We get asked this question all the time. What is appropriate for limits? What should we have in limits? You know, it's a business decision, to be quite frank with you, and every business is different, and every sector is different, and not all publicly traded company is the same, right? So they're definitely different across all channels. However, there is data, and there are analytics that would suggest what you should purchase for D&O coverage based on other companies of the same size, caliber, and marketplace structure. There's a lot more data in here, but for the purpose of the slides, we kind of trimmed it down, but just to kind of give you an idea of what average limits are of what's being taken down. But again, if you're a small company and you're a biotech and you don't have a lot of capital on your balance sheet and your total asset is just your technology, a plaintiff's attorney is not really going to be interested in suing you, right? Because they're not going to be interested in gaining claim to your asset to try and liquidate it, right? So it becomes a business decision that you actually have to think through. But at the end of the day, you need to have some sage advisors who are giving you that advice and direction. Of course, if you talk to an attorney, they're going to tell you to take the max limits and take the benchmarking. And the same thing if you talk to some of your other board members. What does the benchmarking suggest? Just go to the benchmarking. But at the end of the day, you have to make a business decision, and sometimes the cost gets pretty significant on these D&O policies, especially for public companies or S1s that are being filed, especially in the first 2 years of post-IPO. D&O dangers. We talked a little bit about, some of these things that can transpire, but ultimately, again, you have a fiduciary responsibility to operating these entities. Again, it's the same thing for a private entity, even if you only have 2 owners. You have a responsibility to protect the interest of your balance sheet and your shareholder interests. But what happens when you don't, right? And how do you know and how do you analyze what's appropriate or inappropriate for you to do? You're busy and focused on operating your business. Like I told you, I've been there, I've been in your shoes. I know how challenging it is, right? When you start operating a publicly traded company, you're on 2 sides of the coin. Right now you're operating, and you got an operating business, and you got a public business, and you're operating 2 businesses at the same time with limited capital resources internally because you don't have those dedicated individuals in most cases. In most cases of the people probably here at NIBA, right? So I totally empathize with that. So you need to make sure that you're leveraging your vendor partners, whoever that may be, whether it's on the insurance side or whether it's on the legal side or whether it's on social media side or marketing digital distribution. And you need to make sure that you're aligning with people who have that level of expertise. We have had a lot of experience in this market over an extended period of time, so we've built certain things into the policies in manuscript language that is more specific to different types of companies, right? When you look from an underwriting standpoint, underwriters look at, are you public or are you not public? They're not looking at, are you a $1 billion publicly traded company or are you a $50 million publicly traded company, right? And there is a definitive difference in the risk profile from a large public company to a small public company. And understanding that difference enables you to structure deals differently, right? So most of the companies that are under that $300 million market cap range are most likely an insolvency or a bankruptcy risk, comparative to a larger publicly traded company that is a shareholder liability risk. And that's where you have to look at the differences of negotiating your coverage terms within the policy specific to what that risk profile is. And the only way to do that is by doing manuscript language and going into the individual policy language and renegotiating the policy, the policy forms, with the underwriters. Happy to show anybody at any point in time we're here, but I'm happy to show anybody what an analysis would look like if anybody's ever interested in that. At this point, I'm just going to open it up to see if anybody's got any Q&A.
Is it better for a private company to get the D&O while they're private, or wait till they're
That is a great question. So that comes about all the time as well. It is 100% best to get D&O coverage in place as soon as possible. It is a lot more cost effective in structure, which people don't think. People want to wait until the deal closes. If you structure a D&O policy properly while it's private, it is just arbitrarily. You could get $1 million in coverage and you get a retroactive date that started. Retroactive date is the date when your coverage first begins. That is a very important date. If you don't know the terms retroactive date, claims made, or ABC, I suggest that you just do some research and familiarize yourself a little bit with the insuring clauses or structures of a D&O policy. But when you do that in that fashion, you're enabling yourself to buy a private policy that may be $10,000 for $1 million in coverage, not $300,000 for $1 million in coverage. And then what you do is when the company goes public, you remove the public offering exclusion that's part of the policy, but your retroactive date started way back when. And then what's happening is you're getting coverage all the way from the retroactive date up until the IPO date.
For surgical company.
Right? So why is that so important? What if the deal doesn't go public?
Probably.
Right? So even if you have prior pending litigation on your policy once you complete your IPO or your transaction, if the deal didn't go live, you have liability or potential liability for your roadshow, the communications, the representations you made through that entire process. So buying a $10,000 policy mitigates that, and it also saves a significant amount of money because once you actually do list and you remove that exclusion, you're starting at 3 months later or 6 months later whenever the deal actually does go live, right? So you're actually starting that cycle also of that first 2-year period of time of where those high-end costs really affect post-IPO companies. That was a great question. Thank you.
Premium? Discuss premium.
It's going to depend on the entity. It's going to depend on the balance sheet.
Public company, market cap,
Public company, what does the balance sheet look like? 18 months in capital?
say 50 million cash.
50 million cash. What type of limits on a primary basis?
Well, you tell me on that.
Okay, so 300 million in market cap, you're looking at, you should have at least $20 million in coverage based on the benchmarking. And I would suggest in a structure of $20 million primary ABC with a $10 million excess layer. How long have you been public? IPO the next couple months. Okay, so this is a straight S1 listing. I'm going to say ballpark, that deal could probably be done for about $350,000, right? But the key is, does it have individual executive tail coverage, or does it just have standard executive tail coverage, which means that you can't tail out the entire policy, right?
Is that going to change if the market cap changes next year?
That's a business decision again, right? But the benchmarking. Premium-wise? Premium-wise, your premium is going to wind up, well, in this market, market conditions, right? If the market conditions are the same, the longer you're public and the strength of your balance sheet, and as long as there's not a tremendous amount of volatility, the premiums will go down.
But if your market cap increases?
If your market cap increases significantly, if there's a volatile stock, right? If the stock is doing swings, you could expect to pay higher premiums, right? So if the stock just kind of lays dormant or goes up, based on the IPO and the valuation increases significantly, but it's stabilized and you have strong financials, and the financials continue to grow and you actually have earnings, the answer is your premiums will likely go down. Most likely not in the first 2 years, but you could expect it to remain static the first 2 years. But the thing that I would say to look at more importantly when you're looking at those type of transactions is look at what the definition of insured is, right? Like truly negotiate that, because most of the small companies that we're talking about, the definition of insured, like the off-the-shelf policies, will exclude coverage for certain things, like a lot of the consultants and advisors that you use and compensation committees and whatnot, if they're external to the entity, right? If they're internal to the entity, like a larger company would have, they'd be there. But with a smaller company and a deal that's under $300 million in market cap, odds are a lot of the people that you have are going to be external, and coverage would be excluded by a standard policy form. Any other questions?
Thank you, by the way, for showing the benchmarks. So what about for emerging tech? So would you kind of pivot alongside like biotech and that kind of thing? Obviously it's a business decision, right? Or would you still base it on the market cap? Or how would you address kind of an edge case like AI?
I would start off by looking at the benchmarking as the starting point, right? And then I would look at the business, right? And I would say, okay, how much cash do we have on our balance sheet, right? What is the asset of the technology? What's the value of the asset of that technology? Like, what is the true value, right? The biotech technology and the science, trust me, a plaintiff's attorney does not want to deal with that, right? Like, but technology and cash flow, like if you have strong cash flow, that could be of interest. Notice I keep saying the plaintiff's attorneys. You don't want to be a target to plaintiff's attorneys, right? That's the danger zone. So you want to make sure that you have a deflection point of being able to move that risk off of you and onto the insurance policy and give them a target to hit. Yep. Anybody else? All right, thank you.